life year in the US. Starting from zero or close to it and wondering how normal people actually build wealth in 2026 without gambling on crypto or day trading, this video is for you. You don't need a six-figure salary or a secret stock tip. What you need is a plan. Today, I'm breaking down the 5 most realistic, high-impact ways beginners can build wealth in America, step by step. No fluff, just actionable advice that works. Let's start with the absolute foundation, your emergency fund. This isn't just a pile of cash, it's your financial shock absorber. The goal is to save 3 to 6 months of essential living expenses. And when I say essential, I mean rent or mortgage, utilities, food and transportation, the things you absolutely need to survive. If your income is unstable or you're self-employed, I'd strongly recommend aiming closer to 6 to 9 months. That extra cushion will let you sleep a lot better at night. But here's the key mistake most Americans make. They let this money rot in a regular bank savings account, earning basically nothing. As of late 2025, the average traditional savings account pays a pathetic 0.2%. Meanwhile, high-yield online savings accounts are paying roughly 4% or more. That is a massive difference. By keeping your emergency fund in a high-yield account, you're earning a risk-free raise on your own money without lifting a finger. Think about it. If you have $10,000 saved, a regular account might give you $20 a year. A high-yield account could give you $400 or more. This money is not for investing. I repeat, do not invest your emergency fund. It's for when real life happens: a sudden job loss, an unexpected medical bill, or a major car repair. Having this cash accessible means you won't have to go into debt or sell your investments at the worst possible time. Here's your action step. Open a dedicated high-yield savings account today. Many online banks let you do it in minutes. Then, automate your savings. Set up an automatic transfer from your checking account right after every paycheck. Even if it's just 2 to 5% of your income to start, that habit will build your fund faster than you think. Okay, with our foundation secure, let's talk about investing the smart, boring way that actually works. If your employer offers a 401k with a match, this is non-negotiable. It is the closest thing to free money you will ever get. For example, if your company matches 100% of your contributions, up to 5% of your salary, you need to contribute that 5%. No excuses. If you don't, you are literally leaving part of your salary on the table. So, your first investing priority is to contribute enough to your 401k to get the full employer match. Next, if you're eligible, you need to open a Roth IRA. A Roth IRA is a retirement account where your money grows completely tax-free. In 2026, you can contribute up to $7,500 per year if you're under 50. The power here is that when you retire and take that money out, you owe 0 taxes on all the growth. Now, what should you invest in? For beginners, keep it simple. Don't try to pick the next hot stock. Instead, stick with low-cost index funds. A great starting point is an S&P 500 index fund, which invests in the 500 largest companies in the US. Another option is a total US stock market fund, which gives you even broader diversification. Or, for the simplest approach of all, look into a target date fund. You pick the year closest to your expected retirement, and the fund automatically adjusts its risk level as you get older. No stock picking. No guessing. Just consistency. Remember, automation beats motivation every single time. Set up automatic contributions to your Roth IRA every month, and let the market do the heavy lifting for you. Now for the elephant in the room. Debt. Let's be real. High interest debt is wealth poison. It's like trying to fill a bucket with a giant hole in the bottom. The average US credit card APR is hovering around 22 to 24%. Think about what that means. Paying off a credit card with a 22% interest rate is like earning a guaranteed 22% return on your money. Treat. You will not find a guaranteed return like that anywhere in the stock market. It is the single best financial move you can make. So, what's the order of operations? First, make sure you're staying current on all your bills. Second, build a small starter emergency fund, maybe $1,000, so a small surprise doesn't derail you. Third, get that full employer match in your 401k. Once those three are done, you attack your high-interest debt with everything you've got, whether you prefer the debt avalanche method, paying off the highest interest rate first, or the debt snowball method, paying off the smallest balance first for a psychological win. The goal is the same: kill the interest that is killing your wealth. Every extra dollar you throw at that debt is a dollar that's working for you, not for the credit card company. Let's face the truth, income solves a lot of problems. With inflation still a factor, even at 2 to 3%, relying on a single paycheck makes building wealth feel like an uphill battle. This is where a focused side income stream can be a complete game changer. It's not about working yourself to the bone forever. It's about creating a temporary surge of cash to accelerate your financial goals. There are so many beginner-friendly side hustles in the US right now. You could drive for gig apps like Uber or DoorDash, which offer maximum flexibility. You could start freelancing online, offering skills you already have, like writing, graphic design, or social media management on platforms like Upwork or Fiverr. Or you could go local with services like tutoring, pet sitting, house cleaning, or handyman work. The demand for these services is often high. But here is the most important rule, the one you absolutely cannot break. At least 50% of your side income must go directly to wealth building. Don't let it just get absorbed into your regular spending. This extra money has a mission. It goes straight to finishing your emergency fund, paying off that high-interest debt, or maxing out your Roth IRA. The other 50% can give you some breathing room, but the primary goal is to use this extra income as fuel for your financial engine, not to upgrade your lifestyle. This brings us to the final and most powerful step: locking in long-term wealth habits. This is where the magic of compounding really takes over, and your money starts working harder than you do. The key is to remove yourself from the equation as much as possible. Use automation for everything. Set up direct deposit splits, so a portion of your paycheck automatically goes to your savings account before you even see it. Set up automatic investing so your 401k and Roth IRA contributions happen like clockwork every month. Set up automatic savings transfers to your high-yield account. You need to understand this simple truth. Someone who invests just $400 a month for 30 years can easily end up with hundreds of thousands of dollars, and the majority of that final sum will be from investment growth, not from the money they put in. That's the power of time and consistency. As you build these habits, you have to actively avoid the biggest beginner mistakes. First, lifestyle inflation. As you earn more, resist the urge to spend more. Keep your core expenses the same and funnel the difference into your investments. Second, trying to time the market. Don't pull your money out when the market drops or pile in when it's as high. Just keep investing consistently month after month. Third, letting cash sit in low-interest accounts. Beyond your emergency fund, your money needs to be working for you. And finally, avoid over-concentrated bets. Don't put all your money into one stock or one cryptocurrency. Diversification is your friend. By the way, if this video is helping you understand money more clearly, do me a favor and hit that subscribe button. This channel is all about realistic wealth building for everyday Americans. No hype, no scams, just proven strategies. In the end, building wealth in the US isn't about getting rich fast. It's not about finding a magic bullet. It's about building simple, effective systems, being incredibly consistent, and avoiding the dumb mistakes that set so many people back. Start small if you have to. Automate everything you possibly can. And give compound interest the one thing it needs to make you wealthy: time. You can do this. Thanks for watching.